So, finally, sorry it's so late, but is there a possibility of a new approach? So what a number of particularly international tax lawyers have long argued is that a new approach needs to be adopted, which might be referred to, or can be referred to as unitary taxation. It's not entirely a new approach, as I already mentioned briefly. Already when the Carroll report was done in 1935, some countries were applying that even to international investment, but it was also being used in some federal states. It has a long history in the United States and in some other federal countries, I believe Switzerland, but also Canada more recently. So what actually is unitary taxation? I call it unitary taxation. It's sometimes referred to more as formulary apportionment or fractional apportionment, but I think it's important to see it as involving two main elements. The first element is the combined report. It's a requirement that an internationally integrated company should produce consolidated accounts in each country where it does business, and also produce data on its worldwide presence based on the three main factors, which are assets, employees, and sales, and the proportion in that particular country. Now, the advantage of this is this would, for the first time, create a requirement that each tax authority could see the worldwide taxable profits. And if you start from separate enterprise, you start from whatever the company says is the local profits. Now, it's not so radical to be able to look at. Obviously, you can look at financial accounts, so you've got an idea of what the worldwide profit might be, but that's not on a tax accounting basis. But in fact, the United Nations Manual on Transfer Pricing recommends, in the context of transfer pricing, that some of the data that you need, you should ask for consolidated accounts, consolidated global accounts, and also a breakdown of sales. So they recommend that you should already do that. So the advantage of the consolidated accounts is it eliminates all internal transfers, so all profit shifting goes. This is not only transfer pricing, but also the use of affiliates in convenient jurisdictions. Both things are eliminated once you get the consolidated accounts. So often the unitary approach or fractional apportionment has been discussed in the context of transfer pricing, but I think it's equally, if not more important, in relation to these profit shifting, which CFC rules I think are increasingly inadequate for, and which are not adequately dealt with from the point of view of source countries, which most developing countries are. But then on that basis, it enables you to calculate the appropriate proportion of profit. Now, what's important to understand is this profit apportionment is not an attribution of profit. It's a fundamentally different approach. Now here, there's room for debate about the economic implications of it. I think unitary taxation goes with certainly the microeconomics of the firm. All the economists that I've read who've looked at the reasons for existence of transnational corporations, their reasons for existence are the economies of scope and scale, a particular advantage of combining locational and organizational advantages on a worldwide basis. And unitary taxation goes with that logic, if you like, instead of opposing it by saying, well, we must pretend that they're operating as separate entities. But what it means then is instead of attributing the profit, you apportion it. So it says you can't say where the profit is earned. An illustration might be now the issue that we have with Amazon. Amazon in Europe has established a sales affiliate in Luxembourg, which obviously does enormous sales in all European countries. And the profit from sales is attributed to the sales affiliate in Luxembourg. However, one of the main reason that I buy a lot from Amazon is because they can deliver the next day if you buy a book or a TV set or whatever. And they can only do that because they have distribution facilities in each country. But the profit attributed to the distribution facilities is rather low. Now, from the separate enterprise approach, that makes sense because distribution is a low margin business. But Amazon could not possibly sell the volume it sells if it couldn't deliver next day. So it's an integrated business. The separate enterprise approach, it seems to me, cannot deal with that. And the profit apportionment doesn't say whether sales are attributable to Luxembourg or wherever. It simply says you have an integrated business, we'll apportion the profit. So it assumes the profits are earned by the firm as a whole. Now, obviously, the major issue is then, well, what is the formula? Now, the experience has been, particularly in the United States, but I think other countries, that the main formula, the main aspects of the formula one could look at are assets, labour, and sales revenues. Now, these kind of split between production and consumption, if you like. Assets and labour are on the production side, and sales revenue, because sales revenue is done on a destination basis, is on the consumption side. Assets raises the question of which assets, and I think it's important, and certainly that was the conclusion of the European Commission in developing the CCCTB proposal, and it should be limited to physical assets. A major problem with transfer pricing is transfers of intangibles and the illusory location of intangibles, so clearly I think intangibles should be left out, and that would resolve the intangibles problem. So you base it on physical assets, and then there are issues about ownership and so on. Next is a labour factor, and that raises the issue of, are you talking about headcount or payroll costs? Now, within a more or less unified economy like the United States, where wage rates don't vary a lot, they use generally payroll costs. When they looked at it in Europe, they decided in the end to have a split, so that the labour factor, according to the European proposal, would be split between payroll and headcount. On an international basis, there would be obviously an issue there between developing countries with low wage rates and developed countries. But I'll come back to that in a moment. And then finally, sales revenue, which weights the consumption side. It should be by destination. An important point there is that it should no longer be based on the permanent establishment notion. Again, this is to deal with an Amazon type situation. The OECD, I think, got rather locked in when they looked at the emerging e-commerce about 10 or 12 years ago, because they had to apply they thought they would stick with the permanent establishment notion, and it's difficult to describe a website as a permanent establishment. So again, Amazon is considered as being based in Luxembourg, even though certainly in the UK it's Amazon Co UK, in Spain it's Amazon.es. So it offers a local website, but that's not a permanent establishment. But under this approach, I think you'd have to have a broader concept of doing business in a country. Now, obviously, the main challenge is, could you reach agreement on this? And certainly the objection has been, but it goes back to the 1930s. It was very difficult to reach international agreement. Firstly, it should be noticed that you don't have to have worldwide agreement. Certainly in the United States, the states have only had loose coordination. And why is that? They could be compatible unilateral approaches, because if you think about it, there are trade-offs to be had. On the one hand, a state may well say, well, we want to weight the factors that maximise our tax revenue. But on the other hand, if you try and maximise your tax revenue, as you all know, you deter investment. So it's not particularly in the interest, I think, of states. For example, China with a lot of local manufacturing. If China were to say, okay, we're going to adopt a formula which heavily weights labour, and then we're going to tax them heavily, then obviously, firstly, companies would start to save on labour by mechanising, and secondly, they might go to Vietnam or other places. So I think there are trade-offs there, and I think there are factors that would lead to a degree of harmonisation, even if you didn't have a strong international coordination. And at the end of the day, bear in mind that the OECD already says that transfer pricing is not an exact science. The evidence is that it's a think of a number and split the difference kind of approach, highly discretionary. So the idea that you have to have a worldwide agreement and have a very effective system, the question is, would it be better than what we now have? Finally, then, the question is, how do we shift to it? Now, clearly, there are significant issues there. Not surprisingly, there's hesitance about shifting, particularly as, firstly, OECD specialists have got a lot invested in the present system. They understand it, they know it, they've been working it, they've got a lot of intellectual capital invested in it. It has been a difficult thing to keep on the road, and they think they've got a fragile consensus. They don't want to upset it. But I think one can see ways to work towards a transition. First of all, there should be studies. I think because of the view that it's not viable, there's never been a serious study by an international organisation of unitary taxes since the 1930s, and I think that has to be changed. And here obviously is where I managed to convince Mike Moore that maybe the ICTD can play a little bit of a role in doing something that at the moment the IOs are not keen to take on for various reasons, and maybe we can act as a catalyst and at least get the ball rolling on that. So let's at least do some studies. Now it's possible the OECD might take it up, as I've already mentioned. Because of the political concern about profit shifting, they do have this project on base erosion and profit shifting, which is supposed to report to the G20 in February, and I'm very interested to see what they'll come up with. And I think there will be some movement, although they won't say we're going to embrace unitary taxation, but they're going to have to come up with something. Let's see. But it's certainly, I think, I hope that ICTD can do something, and I'd like to talk to any of you who are interested about this. Secondly, regional adoption. We already have it in the United States. There's a serious proposal on the table within Europe, and there's no reason why that shouldn't spread in other regions or sub-regions. I think you should think seriously about it in Africa, where you have regional and sub-regional groupings like the East African Community, SADC, and so on. That might be a sensible approach, as opposed to what we were discussing just now about investment incentives. I mean, unitary wouldn't entirely resolve the issue of investment incentive competition, but it would go a long way towards it because it is based on having a common tax-based definition. It's still possible to offer incentives on top of that, but there is a movement towards harmonisation of the tax base necessary there. But the important thing I think to emphasise is that if it is adopted, it should be adopted on the basis of a worldwide combined report. I think a big defect of the European proposals at the moment is that not only do they envisage the apportionment taking place only between participating countries, but they don't propose a worldwide combined report. And this means it won't deal with tax havens. There's no reason why, even if you're only apportioning between participating countries, you shouldn't agree amongst the participating countries to insist on a worldwide combined report. And finally, combined reporting or unitary could be adopted in sectors where I think there already is agreement that the present system is particularly failing. There are particular types of particularly financial activities, worldwide trading. A trading book is a particular area where it's difficult to identify whether the profits are made in London, New York, or Tokyo if you're passing a trading book around on a 24-hour basis. But equally, some of these internet companies might be suitable candidates for a sectoral application. And some specialists have said, well, even if you don't say you're adopting unitary tax, you could at least say that we'll use a profit apportionment to guide the profit split approaches, which are increasingly the ones that are used in a transfer pricing context. So those are all ideas for a transition, but certainly I think the first step should be some serious studies. So that's why I commend the idea to you and encourage you all to think about it, and by all means talk to me or Mick or one of the research directors if you're interested in participating, or any of your colleagues in all of this. So I hope I haven't bored you too much.